Hi, everyone. I'm Garrett Nelson, Senior Equity Analyst at CFRA. I'm here with one of my analyst colleagues, Arun Sundaram, who published a very informative and insightful report earlier this week on the investment implications of the recent meat plant shutdowns in the U.S. as a result of COVID-19. These shutdowns, of course, affect companies in the packaged food and meat sub-industry, which falls under the consumer staples sector. Consumer staples is an area we really like at the moment here at CFRA, and Arun will talk about some of his top picks in the space in a moment. We have an overweight rating on the consumer staples sector, which is the 11th largest of the 11 sectors in the S&P on a market cap weighted basis. The consumer staples sector is more defensive, lower beta, is generally comprised of companies with more stable cash flows, tends to be more value and income oriented, and has a long history of outperforming the broader market during bear markets and recessions. We also think the sector is attractively valued at current levels, particularly as we sit here on May 1st, given the huge rebound the market has had since mid-March, which has caused a lot of the staples names to underperform more cyclical equities by a pretty wide margin. In the sector, there's several stocks we like that have attractive dividend yields and relatively stable cash flows. Going back to the earlier points, beta is a measure of a stock's volatility or systemic risk in relation to the overall market. By definition, the broader market, such as the S&P 500, has a beta of 1. A stock with a beta of 2 can theoretically be expected to advance or decline twice as much as the overall market. And conversely, a stock with a beta of 0.5 or 1/2 is about half as volatile as the overall market. If you look at the 5-year average beta of consumer staples equities, it's 0.66, which is really pretty low. By comparison, the average beta of a stock in the consumer discretionary sector is more than double that level, or 1.36. And if you look back at performance of consumer staples during the last 2 recessions, during the Great Recession year of 2008, consumer staples equities fell by an average of 19%, which was much better than the S&P 500's decline of over 38%. And if you go back even further to the 2001-2002 recession, consumer staples equities actually rose by 110% on average versus a 33% drop for the S&P over those 2 years. So this is why the sector has historically proven to be a safe haven. And if we drill down further into consumer staples, the sector is really comprised of 12 sub-industries with a total of 72 stocks in the S&P 1500 composite. That's a little less than 5% of the total number of stocks in the S&P 1500. The 3 largest sub-industries from a market cap perspective are household products, soft drinks, and hypermarkets and supercenters. But the 4th largest sub-industry in terms of market cap, and actually the largest sub-industry in terms of number of companies, is the one we're going to discuss today, and that's packaged foods and meats. Those companies comprise over 1/3 of the total number of companies in consumer staples and include such names as Tyson Foods, General Mills, Kraft Heinz, and Conagra. So with that as a backdrop, let's bring in Arun here. Arun, a lot of meat processing plants in the U.S. have been closed recently due to coronavirus concerns, raising concerns of possible meat shortages. What are you seeing? How significant is this? And are these primarily beef, pork, or chicken plants?
Yep, thanks, Garrett. So yeah, it seems like just every other day we're hearing about another meat plant closure. And at this point, we estimate over 20 plants have closed at some point over the past few months due to coronavirus concerns. Most plants have been pork plants. However, a few beef plants have been closed. And chicken plants have found ways to become pretty resilient right now. They have largely remained open with minimal disruption, likely because chicken processing is a little less complex than beef and pork, and it's less labor intensive. But the point I want to make is that the closure of these plants is a major concern because meat processors are dead center in the food supply chain. These companies, they purchase livestock from farmers, then slaughter them and process the meat before packaging it and sending it off to wholesalers and retailers. Because the middleman in the supply chain is essentially the bottleneck right now, both sides, that is the farmers and the wholesalers and retailers, are negatively impacted. We think farmers have been the most impacted due to these plant closures because they were already facing an oversupply of livestock because of lower food service demand as the world essentially shut down because of the coronavirus. And now their situation is amplified because they're unable to send their livestock that's ready for slaughter to these processing plants. And obviously, as everyone knows, retail demand is still very much strong right now, but as everyone's staying at home, but they're just unable to send their livestock to these processing plants.
Okay, and do you have an estimate of how much pork and beef production capacity these closures have taken offline? And is this a short-term phenomenon, or do you see these plants being offline for a while?
Mm-hmm. Yep, so it's difficult to get a precise estimate on just how much capacity has been lost. This is because there's likely dozens of additional facilities across the United States that are running on a limited capacity right now because of worker safety concerns, as well as worker absenteeism. Many workers are just not showing up to plants these days. One, because they fear contracting the coronavirus, and two, they have other obligations such as taking care of other family members at home or taking care of their children who are home from school. But one industry group did put a number on this. They estimate that about 25% of U.S. pork production capacity is down, and 10% of U.S. beef production capacity is down due to these shutdowns. Most of these plants were expected to be offline just until most workers got tested and the facilities were thoroughly cleaned. However, a major development happened this past Tuesday. President Trump signed an executive order by invoking the Defensive Production Act in order to keep meat and poultry processing plants open. This is pretty critical because now we can hopefully not see any additional plant closures in the next couple of weeks. But before this executive order was signed, we never thought that there would be a major meat shortage in the retail outlets in the first place, because right now there's about 2 billion pounds of chicken, beef, and pork currently sitting in cold storage reserves right now. But now that this executive order has been signed, there's less of a chance that we'll see any meat shortages.
Okay, and how have profits been impacted, or will they be impacted for meat processors? It sounds like they'll be selling lower volumes due to capacity constraints, but what about the pricing side and also input costs?
Yep, that's a good question, because there's a very interesting dynamic that's currently playing out. On one side, wholesale prices for all proteins have risen over the past month due to lower industry production. And at the same time, prices to procure livestock have fallen dramatically. So the combination of higher selling prices and lower input costs have made margins very, very attractive in this industry right now. This is most evident in the pork industry, since this industry has been the most impacted by these plant closures. Most of these meat processors, they purchase their livestock for slaughter using future contracts. And if you look at the lean hog future prices for this year, they've lost nearly a fifth of its value since the beginning of the year. Whereas pork wholesale prices, so selling prices, have increased about 20% since the beginning of the year. So the longer the meat processors are going to be bottlenecks in this situation, this margin dynamic should continue, which is very much needed for these players because of all the extra costs that they're currently incurring in order to keep plants running and workers safe during this pandemic.
Okay, that's really good information on the pricing side. But how about retail prices? How will consumers be affected by the supply disruptions?
Yeah, so we think retail prices will increase, but not nearly to the extent that we're seeing at the wholesale level. And again, this is because of the amount of cold storage inventory that's currently held across the United States. Like I said before, there's currently about 2 billion pounds of protein currently sitting in large refrigerated chambers. And this is way more than historical averages. Typically, cold storage reserves deplete in the spring and summer months once demand ticks up. However, this year, because the coronavirus hit just before the spring season, cold storage reserves have actually increased. So the longer restaurants are closed, we'll likely see a sufficient amount of meat reserves. Though to make sure this meat is coming out of the reserves and into retail, we do need some workers. So plants do need to be open, but the bright side is that you don't need nearly as much workers. So there shouldn't be a problem with any labor shortage issues here.
Okay, and shortly after you published this report, President Trump, said he would sign an executive order to keep all the meat processing plants open. Does that change your thinking at all on this situation?
Yeah, it's, not so much, because even before the executive order was signed, we believe the plant shutdowns would only be a temporary situation. Now that the plants might reopen faster than expected, and actually more importantly, there might not be any additional plant closures in the near future. So that's all positives for the industry. And then, so once production gradually increases, these companies will slowly start realizing efficiencies and economies of scale, which should further improve their margin profile. And then if you look in the long term, we still have a positive fundamental outlook on the overall industry. And the number one reason is because there's a massive protein shortage right now caused by a disease called African swine fever. This disease has killed off roughly 50% of China's hog population, which equates to roughly 5% of the entire world supply of meat. So if you just think about that for a second, 50% of China's hog herd equates to 5% of the entire world supply of meat. So this type of shock in the supply chain will likely be felt for many years to come, which is why we think US protein will continue to experience high demand for the next couple of years, at least.
That's pretty amazing. So help us understand who the winners and losers are from this trend, and what are your current recommendations and price targets on those names?
The big winner here, we think, is Tyson Foods, especially given the recent developments of the federal government stepping in to deem meat and poultry processing plants as essential businesses. So we have a strong buy rating on shares of Tyson with a $90 price target. So for those who aren't aware, Tyson is one of the world's largest suppliers of beef, pork, and chicken. They have a very diversified business model with relatively equal exposure to chicken, beef, and pork. And they also sell their products in roughly 150 countries across the globe. So we think any issues that they're currently facing right now are mostly transitory in nature, and that there's a lot of growth potential over the long term. One, because of African swine fever, like I mentioned before. But two, there's been several trade agreements that have been recently signed, which should help support US protein prices. For example, phase 1 of the US-China trade deal was recently signed. Some other agreements that have been signed over the past year are the US-Mexico-Canada agreement, and then the US-Japan trade agreement. It's 3 major trade agreements all signed, which should help improve the demand for US meat. Another winner in this situation, we think, is Hormel Foods, although we have a hold rating and a $38 price target here. Hormel is not as diversified as Tyson, and its shares are already trading north of about 20 times forward earnings, which seems a little expensive for a company that is tied to the commodity markets. Lastly, we also see pure play chicken producers as a major winner in this situation. One company that we think will come out as a winner is Pilgrim's Pride Corporation. There are already reports of retailers stocking up on more chicken right now because of potential shortages to beef and pork. And then in the long term, we think chicken producers will benefit if we enter a prolonged economic downturn, because chicken is typically considered the more value protein compared to beef and pork. So we have a $26 price target right now on shares of Pilgrim Pride, which is roughly 12 times our forward earnings estimate.
All right. Thanks a lot, Arun. That's really good information. So strong buy on TSN, buy on PPC, and hold on HRL. You can see Arun's report on MarketScope Advisor, and also the company reports on each of those 3 companies, and all the other companies within consumer staples, and over 1,500 companies total on MarketScope Advisor. Thanks very much for listening to this today, and have a good weekend.